that's the outside of the inside market, because everything inside of that is now the inside market, right? So this is what we start to see. The outside of the inside market doesn't include all the big outside sells or outside buys or whatever. So that's what we're paying attention to. In this world, that's what your candlestick will look like. So obviously, if that's what your candlestick will look like, if the open of the candlestick is here, and that's what the liquidity on the outside looks like, the price will trade, in most cases, will trade to here, and then we'll trade to here, and then it'll finish somewhere about here. So that's what will happen. And then the outside-inside market will start developing, and then it will be an open here, and then it'll maybe drop down to this price here. It'll then maybe rally to that price there, and it'll close here. If the outside-inside market then drops down a little bit here, what normally happens is the price will go to here, it'll test up to that price there, and it'll drop off to that price there. The outside-inside market, you can see that that's the idea. Now, obviously, in the world of normal trading, that's about 5 ticks away. You know, maybe 5 ticks to the top side, 5 ticks to the bottom side. But in the S&P just now, it's about 7.5 points away. And if you don't think that this is true, take a look at this market with the actual limit order book attached to it. Just see how that every candle that forms at the end of every candle, the outside-inside market is almost uniform. Every time you will look at that chart, it's almost uniform from the top to the bottom. You see that? You can start to recognize the shifting shape of the liquidity order book. You can start to recognize that this is how the market eventually develops in those areas. The outside market, the inside market is usually consistently wide between these points. And that's what you start to pick up on when you're looking at limit order books. You start to recognize the idea behind the limit order book. You can start to see the shift in the order flows. You can start to recognize some key levels and so on. But it's just something to remind yourself. It's not really particularly relevant. It's just what it is. It's just exactly what it is. It's the outside size of the inside book. And you can see the outside size of the inside book resides in these areas here. That's the outside size of the inside book. The other size outside here would be the other commercial orders here, or other commercial orders here, or other commercial orders here. And everything that's inside that is the inside book. That's the market makers predominantly trading on the inside book in this space here. And obviously that's something that we do pay attention to, because that inside book there is what moves the most. The outside book is usually relatively static in terms of the total volumes, but the inside book is what causes the short-term candles to become bullish behind the market, for example. It's the inside book. The inside book is everything inside those big real trade levels. So we can start to recognize that that is how it forms. So something to pay attention to. The size of the volatility is important when we're trading. It gives us an idea of how much volatility is in the markets, and that's how we see it. And watching this S&P, the last dealer trade was that buy trade we shouted off of at 38s. It's gone back up. This is on ES1, not the obviously the next contract. So ES1 is H. So buy side off the 38s at the moment, watching to see if there's any dealer shorts coming into the top edge at the moment, and not quite seeing it just yet. There's definitely a dealer seller at 47.5s at the top edges, but it's not at that price yet. So I was waiting to see if it was going to trade the 47.5s and see if the dealer short still came in. But there's definitely a dealer short into those prices, so long as it makes a shift on to try and get up to that price relatively quickly, or we're going to lose the value of that 47.5 area. So at the moment, dealers like the squeeze higher, but they have got the sell lined up just now off the 47 high break. So that's what they're thinking. They like the squeeze higher just now, but they're trying to get the sell at higher prices, 47.5, judging by their inside-outside markets. So they're bidding up the market in the short term. They're trying to get the squeeze into that 47.5 top line for a short trade. So they're trying to bid it up. It's now 40, 45 traded, 45 quarters traded, 45 halves traded, 46 traded, 46 quarters. See what I said? See what I said? They're going to bid it up next, and then they're going to make a decision. And when it bid it up into that 47.5 break, we're going to be able to get a decision against that top line. We just called it, guys. We just called it. We said the dealers were bidding the market up and that they would try and get the break into that 47.5 sell trade.